Good morning, everyone. Thank you for joining us to hear Craig Hoffman speak a little more technical today, ins and outs of the new Section 538 Trump accounts. So thanks for all for joining us. We are offering CE, so just make sure you stay for the entire webinar, complete the survey at the end, and we will be emailing out a CE certificate within a week. We have with us today, he won't be on video. We're having some technology issues, but Craig Hoffman is presenting today. Craig is an attorney and senior consultant with us here at Nova, been practicing for over 40 years and has really industry expert here. So we're looking forward to hear what Craig has to share with us today. Feel free to type questions as we go along, and we will definitely pause and try to answer as many questions as we can towards the end. So this presentation will be uploaded to our YouTube link after its completion. And with that, I'll turn it over to you, Craig.
Thank you, Kim. Good afternoon to those on the east side of the country. Good morning to those in the west, and good day to everybody in between. We've got a interesting topic today, something new on the horizon, the Section 538 Trump accounts, a new way to give kids a head start. As always, this is not meant as legal advice, personal legal advice. It's general knowledge. I hope you enjoy it. For CPA people, I think this is Texas principally, but if you have any questions with CPE credit, please reach out to our webinar staff. That's me, as Kim alluded to. I've been doing this for 40 years. Seems like forever, but no, I still enjoy it very much. I looked at the attendee list. I see a lot of familiar names and faces, or names, and I place spaces, which leads me to say many of you may know me, but not know the guy that was on the little webinar announcement. We call him AI Craig. If any of you know me, you know that's not me. I didn't notice it at first, but after it went out, I asked our webinar person who put this together, where'd that come from? And she said she used AI to put in a QR code, and somehow it messed with my picture. So maybe it's good. Think of me like I looked 30 years ago. It was without the camera on today, but in any case, that's really not me, as many of you know. But moving on. So what are we going to talk about? We'll begin with a little background on these new accounts. Then we'll go through the details of how they will work. That's really what I want to focus on, how you set them up, who you can set them up with, what you can put in, when you can get money out, whether you should consider an employer-sponsored program, permitted investments, and then we'll talk a little bit about what's next and some closing thoughts as well. So let's begin with the background. This whole idea of a Trump account actually long preceded the One Big Beautiful Bill. It had been somewhat even of a bipartisan proposal. Ted Cruz of Texas was one of the main proponents of the idea of giving kids a head start on financial security by setting up some type of IRA for them. As it wound up in the One Big Beautiful Bill, it has become known as the Trump account. It's under Section 530A of the Internal Revenue Code, a new code provision. Under the new law, any child in America who is under 18 can establish an account to which contributions can be made that will benefit them after they reach age 18. And contributions can be made by family members, will be the typical, but there is also a provision in the new law whereby the federal government will provide a pilot contribution for U.S. citizens born between 2025 and 2028. So the idea, this is a savings account that family members can contribute to it, but In addition to the pilot contribution, there are provisions whereby employers, governmental entities, or charitable organizations can also make contributions. And there's been a great deal of interest in this opportunity going forward. It's a new thing. It was passed last summer, so it hasn't been a full year. That often leaves the regulators in Treasury and IRS scrambling to get out guidance in order to implement these new provisions, which became effective this year. In late December, or in December, late last year, the IRS put out a notice that provides the initial guidance and what we are principally looking to these days for how to make these things work. In early March of this year, we also got two sets of proposed regs that were very focused on two distinct subjects. One, how to qualify for the pilot contribution for eligible children in that age category, as well as how to open an initial Trump account. So clearly the focus was to get these things rolling. However, we do not have any guidance on many other areas of the new law, in particular, how to apply the contribution limits and some nuances there, how the employer-sponsored plans will work, what requirements, the details on how those requirements will be applied, and importantly, we don't have anything on reporting obligations of employers and IRA custodians. So those subjects will be addressed in the future. For now, we're relying on that 2025 notice number 68. So the first step in setting up an account for a Trump account is to make an election to establish an account. And that can be made for any child who has a social security number and has not attained the age of 18 by the end of the calendar year in which the account is established. You'll hear throughout this presentation about 18 and 17. The rules are set up with a so-called growth period that runs through the calendar year in which you turn 17. And that's the period when contributions can be made. That's the period when an account can be set up. Anytime up into and including that calendar year. Once you begin the calendar year in which the child turns 18, they're no longer eligible. So the idea, anybody under 17, under 18, remains under 18 by 12/31 of this year, can have an account. The sooner you get going, the more contributions that can be made. The beneficiary, the child, is often referred to as the Trump account beneficiary. Now, there are limited folks who can open the Trump account on behalf of the child. That person's referred to as an authorized individual. And generally speaking, there is an order of priority as to who can do it. It begins with a legal guardian, if there is one. Obviously, that's not often the case. So in most cases, it'll be the parent or an adult sibling or a grandparent who's authorized to set up the account. But it's done as in order of priority, which means that if there is a parent around, then the grandparent is not eligible to open the account because the grandparent is lower in priority than an existing authorized individual. So in most cases, what we'll see is a parent opening up this account for their child. They can only have one account at a time, so a well-meaning grandparent can't go out and set up a second account. Only one is permissible for any child at any time. One additional requirement is that if you are electing to open the account and at the same time are electing to receive the $1,000 pilot contribution because the Trump beneficiary of the account is within the 2025 to 2028 birth years. The authorized individual in that case must be somebody who is eligible to claim the beneficiary as a qualifying dependent on their income tax return. So the idea is if you're claiming the $1,000 contribution, you've got to be somebody closer in relation than just a parent. It's got to be a parent who can, or an authorized individual if there's not a parent, but one who can claim the beneficiary as a dependent on their tax return. The way of making the election, there are two ways. One, you can do it the old-fashioned way, filing a paper IRS form. It's form number 4547. That's no accident. That corresponds, obviously, to President Trump's two terms as president, the 45th and 47th. That form can be filed. Many already did file it with their 2025 tax return. It can be filed separately, even without a tax return, if you've already filed for 25 and want to establish it that way. But the preferred way, the way the government recommends, is to set up the account by going online to a new website, the trumpaccounts.gov website, and you can go through, scroll through, fill out the information, and elect to set up the account that way. Now, the government received a lot of comments beseeching them to apply automatic enrollment such that the any eligible child born between 2025 and 2028 would automatically be enrolled and get the $1,000 contribution. The Treasury declined to do so, citing conflicts with taxpayer privacy laws. They preclude them from disclosing taxpayer information to anybody but the taxpayer. For better or worse, if you want the $1,000, the only way you're going to get it is to make the election. If you want the account, the only way you can do it is by making the election. Once the Treasury Department receives that election, they will process it and then send information to the authorized individual with the information on how to activate the account. That authorized individual then morphs into the responsible individual who's thereafter is in charge of the account, makes investment decisions, makes decisions as to rolling the money to a different Trump account, or appointing a successor if they choose not to serve anymore. And again, the thinking is in most cases, this is going to be the parent of the child beneficiary. And the primary interface for managing the account is going to be through an app that was put together by the government with help from some of its partners and is up and running and available for downloading as we speak. And in fact, the program is rolling out as we speak. The emails with the information necessary to activate the account started going out the end of last month. The authorized individual will then go online in the app to establish the account. Those emails are going out on a rolling basis because so far it's been quite successful. According to the government, as of the end of May, there were already 6 million people or 6 million beneficiaries for whom account elections had been made. And of those 6 million, 1.4 million were people claiming the pilot contribution. So it is rolling to our July 4th kickoff. The Trump administration has been pressuring Treasury officials and IRS to make this work and have it ready to go on July 4th. And I believe they're going to do it. With that said, there are the evil element out there. Apparently, there are some hackers or what have you that are trying to lure people into the wrong places for Trump accounts. So the government has warned that any references to Trump accounts in phone calls or text messages or social media should be regarded as fraudulent, and you should only act through the official government app and channels. For managing the program, the government selected Robinhood to serve as the broker and initial trustee for all initial Trump accounts. That's the only place to go, and Bank of New York was served to act as custodian and financial agent to run the show, if you will, on behalf of the Treasury Department. So if you want to set up a Trump account, there's only one place to go, and that's to the app, and Robinhood's going to be your broker for the initial app. But that is not true for rollover Trump accounts. Under the new law, any bank or other person approved to be an IRA trustee can be a Trump account IRA trustee, because the Trump account really is a new flavor of individual retirement account. It's the best way to think of it. And even non-bank entities who were approved by before the beginning of this year can serve as Trump account non-bank trustees. There's no additional selection, and without question, it's expected to be hot competition amongst service providers to get these Trump accounts into their financial products. The problem right now is with the one, there are no accounts at all, so there's nothing to roll over, and two, we're going to need further guidance from the government on how to facilitate those kind of transfers with reporting obligations, and frankly, again, we do have no idea how Robinhood, what procedures they will have if and when a Trump beneficiary or their authorized individual decides they want to roll the money out from Robinhood to a different financial services company. So that's forthcoming. From there, we move to what contributions can be made. And although these rules are effective as of the beginning of this year, no contribution can be made until July 4th. And the whole purpose was to give the government Treasury Department time to put together the plumbing to roll out these accounts. Contributions then can be made for the calendar year in which the account is established, and can continue to be made through and including the calendar year in which the beneficiary attains age 17. As I mentioned earlier, this is the growth period. The calendar January 1 of the year in which the Benny turns 18, you're out of the growth period. It's a regular IRA at that point. Another important point about contributions to Trump accounts is they need to be made by 12/31 of the calendar year to which they relate, for purposes of that year's contribution limits. That is different, unlike the normal IRA rules, where you have until the due date of the taxpayer's tax return to fund the IRA and relate it back to the prior year's contributions and take a deduction in the prior year's tax. So it's going to be important to recognize that the deadline is earlier when you're dealing with these children Trump accounts. There are 4 types of contributions that can be made. The most notable, the one that will be most frequently thought of are normal contributions, i.e. made by the parents or family members of the beneficiary. You can have employer contributions through a 128 Trump account contribution program. The limited pilot contributions for those born in that 4-year period. And then we have sort of a wild card in the general, qualified general contributions. And the beauty of the Trump account is, I mean, there's always been recommendations. If you've got a kid who's working, have that child put in the money in an IRA if they're self-employed or what have you. Well, they've got to have earned income in order to do that. For the Trump account, the beneficiary does not have to have any earned income during the year. That is not a prerequisite to making the contribution. So let's talk about the four types. The normal contributions, again, are made by parents principally. They are made on an after-tax basis, which means there is no deduction to the contributor, but the beneficiary ends up with what we call after-tax basis in the account, which means ultimately when the principal amount of what was contributed as a normal contribution will come out tax-free, and only the earnings generated on that contribution will be taxable because it was made on an after-tax basis. And again, the potential contributors, the prime suspects, are the parents or other family members, such as grandparents, the proverbial rich aunt or uncle, etc. But if you read the law, they're literally any person can make a normal contribution. It can be a family friend. It can be an acquaintance you met on the bus who just kind of liked you and said, I want to give your kid $5,000. It doesn't matter. Anybody can make it. However, the maximum normal contribution for a calendar year is $5,000. And that's from all sources that might contribute a normal contribution. That 5,000 will be increased beginning in 2028. And if there is an employer contribution for the year, the aggregate of normal and employer contributions can be no more than 5,000. As we'll see in a moment, the employer limit is 2,500. So conceivably, you could have an employer contribution of 2,500 and a normal contribution of 2,500, and that would be within the $5,000 normal contribution limit. The second type of contribution, as I just alluded to, employer contributions. They must be made through a formal Section 128 employer-sponsored Trump account contribution program. The contributions made in an employer-sponsored plan must be to the account of an employee of the employer, or more likely to the dependent of an employee of the employer. If it's contributions from an employer plan are going to an employee, obviously that employee's got to be eligible, i.e., under 18. It's still in the growth period, which, you could have a McDonald's think this is a great idea to make contributions for some of their teenage workers. But the most likely recipient is going to be the account beneficiary for an employer-sponsored plan is going to be the dependent of an employee working for that employer. Importantly, if you are making contributions through an employer program, certain requirements must be met, and we'll go into greater detail on them a little bit later. But among them are the non-discrimination requirements, which must be satisfied for the employer contributions to be tax-free to the highly compensated. And depending on your demographics, because of that, the employer-sponsored plan may not work in some of the doctor lawyer plans, as fondly have called them over the years. The maximum employer contribution is $2,500. That will be COLA adjusted, and as I already mentioned, the aggregate of employer and normal contributions cannot exceed $5,000 as adjusted for COLA down the road. The third type of contribution then is the pilot program, and it's free money. You got to be a U.S. citizen. You've got to have a social security number, and you have to be born in 25, 26, 27, or 2028. If you fit within that criteria, then you too, congratulations, you get $1,000 pilot program. Feel like I'm on Oprah here. You get 1,000. You get 1,000. In any case, it's free money. Why, so there's absolutely no reason not to take advantage of this if you have a child born in those years. As I already alluded to, the election to open the account to get the pilot contribution will need to be made by a person who anticipates the account beneficiary will be their qualifying child under the dependent rules, the dependent deduction rules of 152C. There are some nuances in that determination, but generally we're talking about a child who can be claimed as a dependent on your tax return. Keeping in mind you're filing this election, let's say today in 2026, and it's June. You don't know for sure if you're going to be able to claim that child as your dependent. Circumstances may change over the next 6 months of the year. And what the guidance provides is that if you reasonably anticipated, but it turns out it was not to be, that you didn't get claimed dependent, the election is not voided. You will still qualify for the contribution under the magic rationalization that the Treasury will open it for you in that circumstance. Lastly, and certainly not least, are the qualified general contributions. These can only be made by 501c3 charitable organizations or by states or subdivisions of states, but not U.S. possessions or Indian tribal governments. So don't ask me why those were singled out as not being eligible to make qualified general contributions. In any case, these charities or governmental entities must transfer the contribution to the federal government through to the Treasury Department, and the Treasury Department will then be responsible for depositing the monies in the Trump accounts of the class that has been selected by the donor to receive it. Now, the classes that can be used are limited. The donor, the general contribution from the donor must go to either all account beneficiaries, which is unlikely. We're talking 6 million people. All account beneficiaries born in a particular year or years, or account beneficiaries who reside in one or more states or specified geographic areas. That general contribution has to be divided equally amongst those in the eligible class. So it's got to be per capita. They don't have compensation to divide it on. So each individual in the class gets the same amount, and no additional eligibility criteria may be applied. And that's really coming from the language in the Internal Revenue Code. It wasn't something the Treasury made up. However, it seemingly is restrictive to some donors. We'll come to that in just a second. So I predict that may be loosened when proposed regulations on this topic are issued. The beauty of a general contribution, it is not counted toward the $5,000 contribution limit, nor is the $1,000 pilot program. I'm not sure if I made that point. So the $5,000 contribution limit only applies to the normal contributions, as I call them, and employer contributions. Everything else is not capped, except by the largesse of the donors. The donor has to file an application with the Treasury telling them what the contribution amount is, who it goes to, and whether they're willing to let their name be disclosed. Whatever they donate, it's got to be enough to give at least $25 to each beneficiary within the eligible class. And the Trump administration has been out lobbying their friends and states and companies, everybody out there, to join in this program. And in fact, with great fanfare at a White House press conference, Michael and Susan Dell's foundation, the Dells of the Dell computer, of which I'm using right at this moment, as a matter of fact. Anyhow, my laptop helped fund a 6.25 billion with a B contribution that their foundation is making that will provide a $250 contribution to account beneficiaries under 10 who live in zip codes with median income below 150,000. Well, that's pretty focused. I'm not sure the median income proviso works with the guidance with regard to eligible classifications, but I suspect that they will find a way to make the Dells happy with what they want to do. And jumping on board, Ray and Barbara Dalio, another wealthy hedge fund titan, announced that they too would add $250 to match the Dell contribution for beneficiaries living in Connecticut, which is where Ray Dalio is from. In addition, a number of states are jumping on the bandwagon, with states like Oklahoma, Texas, Tennessee, with more to come, all announcing contributions, general contributions for residents of their state. So more to come. This is just rolling out. A number of companies, I didn't bother listing them. You can Google it if you want. But at least 20 to 30 companies have already announced that they too are going to be making Trump account contributions for certain employees under an employer-sponsored program. As I alluded to earlier, normal contributions are made on an after-tax basis, meaning that the beneficiary gets basis in that contribution that will not be taxed when ultimately distributed. But everything else, whether it's an employer contribution or the pilot or the qualified general contributions, those are all made on a pre-tax basis. And so they're not includable in the beneficiary's income when made, but will be taxed ultimately when distributed from the Trump account, or ultimately after age 18, it becomes a regular IRA. And we'll talk about that as well. The investment earnings that accrue over the life of the account are also taxable income ultimately when distributed from the plan. And it should be pointed out that distributions that are made before age 59 and a half are also potentially subject to the additional income tax on early distributions before 59 and a half, unless another exception applies. Speaking of distributions, there isn't a lot to say about distributions. In that, the whole purpose of this account is for children to benefit from the magic of compound earnings. So during the growth period, up until January 1, in which the Benny turns 18, during that growth period, no distributions are allowed. Period. End of sentence. There are rollovers that are allowed. A rollover from one Trump account to another Trump account has to be done as a account to account transfer. It's got to be a direct transfer, and it's got to be the entire account so that a beneficiary never has more than one Trump account existing at the time. So that's really not a distribution. The other distribution option, if you will, is a rollover distribution to an ABLE account that can only be made during the year in which the beneficiary will attain age 17 during that calendar year, the year before the last year of the growth period. An enable account is a tax-favored savings account for disabled individuals. I'm not going to go into all the details, but it is a potentially better deal than the regular IRA and should probably be considered if the beneficiary is disabled at the time of that year in which they turn 17. Any IRA provider is eligible to serve as the trustee, custodian of the account, only one account at a time. And so once the transfer is completed, the transferring account's got to be closed out. And you can have as many rollovers in the life of a Trump account as you want. You can roll it to a new account every year as long as you never have more than one account in existence. Then the person who authorized, the authorized individual who opened the account, who became the responsible person, is the one who decides where the money goes, how it's invested, if a rollover is made during that growth period before the beneficiary turns 18. Importantly, when there is a rollover, direct transfer from one Trump account to another Trump account, or from a Trump account to an IRA down the road once the growth period is over, it is the responsibility of the transferring custodian to provide the receiving custodian with sufficient, with the information with regard to the basis in the account, how much of it was made on a after-tax basis, as well as any contributions made during that calendar year, which the accepting trustee needs to have in order to properly administer the account, make sure the contribution limits are abided by, and that ultimately the distribution is taxed appropriately. Once we reach that magic end of the growth period, the year in which the Benny will turn 18, the Trump account status ends and distributions can be made just like under a regular IRA at any time. So the account beneficiary on that magic January 1st has unfettered access to the account at a relatively young age, which may be problematic and may not be. You know, the problem is when you open an account for a 1-year-old, do you really know what he or she is going to be like when they turn 18? Having been through that, I've got a 34-year-old daughter now, and there were times over the first 17 years I wasn't quite sure. She turned out great, and actually I probably would have done this if we had such a thing. But in any case, that's something that needs to be considered. And if a parent wants more restrictions, for example, this is really meant to save for the child's college education, they may want to consider a different program, tax favored savings, such as a 529 program. The problem there, it's got to be used for education. The Trump IRA, once distributions can be made, you can use it for whatever you want, but potentially subject to the additional income tax penalty. Whoops, went too fast. Sorry about that. We did that. Okay. So normal contributions, the after-tax basis will not be taxed. Everything else is taxable, and taxable amounts distributed before 59.5 will be subject to the 10% additional income tax penalty unless an exception applies. What if the Trump beneficiary dies, God forbid? You know, that's at a young age, it would be unexpected, but it does happen. Well, if that happens, the account loses its status as a tax-favored Trump account as of the date of death. The death beneficiary named on the account is immediately taxed on the fair market value of the account at the date of death, minus the principal amount, the basis that's there. So the non-basis amount is immediately taxed and the account must be immediately liquidated and paid out to the death beneficiary, or if there's no death beneficiary named, to the child's estate. If the Trump account beneficiary dies after, when it's no longer a Trump account, after they've the end of the growth period, then the normal IRA rules apply. So that the distribution the death distribution can be a named beneficiary, and that beneficiary's withdrawals will have to satisfy the required minimum distribution rules. Kitty tax. I don't see many people talking about this element to consider as part of Trump accounts. Back, I think it goes back to the '86 Tax Act. Congress passed a rule to keep parents, high-income parents, from trying to shift income from their tax return to their kids' tax returns, and by doing so, take advantage of a lower marginal tax rate the child would have as compared to the parents. To prevent that kind of shenanigans, Congress enacted the kitty tax, under which unearned income received by a child is often taxed at a parent's marginal tax rate rather than a child's normal tax rate. The kitty tax applies only to unearned income, and it applies to children who are under 18 or children who have attained age 18 up through age 23, who are full-time students and who earned income. The money they actually make is less than 50% of their financial support. So in other words, anybody under 18, or if you got a kid in college that you're supporting and they got a summer job, but you're paying the lion's share of the bills, they're going to be subject to the kitty tax. And it only applies to so-called unearned income. So if your kid's out working a summer job, dipping ice cream cones, that's not subject to the kitty tax. But a distribution from an IRA or a dividend from a stock is unearned income. And that unearned income is taxed at the parent's marginal tax rate once it is in excess of $2,700 in the calendar year. So the first $2,700 of unearned income for a child subject to these constraints is taxed at their marginal rate, but thereafter we look to the parents, which at the highest marginal rate could be 37%. And this also would apply to the taxable income generated by converting what was a Trump IRA, which became a regular IRA at 18 and was converted to a Roth IRA, which some are suggesting, and I'll come back to that before we finish, that may be a problem. So the kitty tax can be avoided. The simplest way is just wait till the kid's 24. You're done. You don't have no problems there. Or if there are withdrawals needed, say you want to use some of the Trump account to pay for college, make sure you're not taking out more than $2,700 in any given year. But the kitty tax clearly needs to be considered when distributions ultimately are going out to the Trump beneficiary. The Trump beneficiary can also roll it over to an IRA. And once you do that, that would allow for the Roth conversion. The benefit of the Roth conversion is that let's just assume we'll avoid the kitty tax at 25, 24. We convert a $30,000 Trump account to Roth. Well, you take an income tax hit on the earnings up to that point, and you take an income tax hit if there were any pilot contributions or general contributions or employer contributions because they went in on a pre-tax basis, but you're taking that income tax hit when one would think a 24-year-old is going to be in his or her lowest tax bracket of their life. And by doing so, you now have the benefit of tax-free compounding, where ultimately, like any Roth, it'll come out entirely tax-free. So I'm not going to try to get into all the munitions about tax planning per se with this. I'm trying to really focus on the technical requirements, but clearly there is an opportunity for some substantial tax savings. For the Trump account providers, if they want to, they can write their Trump account document to mandate when the growth period ends, the Trump account will be automatically transferred to a regular IRA under a regular IRA document. That avoids having language that no longer applies still resident in your IRA document. I'm not sure that's that big a deal. If by some chance the Trump accounts includes only pre-tax contributions that can be rolled over to a qualified plan, but that's highly unlikely if any normal contributions are made during the life of the account by parents or grandparents or anybody making a normal. If assuming it does have after-tax basis, the only place it can be transferred from the Trump account is to a regular IRA. Which takes us to the employer contributions. As I've already alluded to, it's got to be under a 128 formal written program adopted by the employer, whereby you can make contributions. The employer can make it for employees who are under 18 or more likely dependents of employees. Employers can contribute up to $2,500 per year per employee. That's not per dependent of the employee. So if I've got one child, I can get $2,500 for her account, done. If I've got two kids, I can get $2,500, but it's got to be split up amongst my two kids' accounts. And they count, as we've mentioned, the counts toward the 5,000 annual contribution cap and will be COLA adjusted beginning next year, or excuse me, beginning in 28. The 128 plan non-discrimination requirements were incorporated in the statute by merely referencing pretty much all but one of the same rules that apply under 129 dependent care plans. And employer-sponsored dependent care plans have been around over 40 years. And somehow we've managed to run those plans without IRS guidance because there has never been any published regulations on how to apply the non-discrimination requirements or pretty much anything else in 129 plans. There have been some IRS unofficial, less official pronouncements and the like, but no regulations. Well, the inclusion of Trump accounts in the one big beautiful bill has resulted in a fire being lit under Treasury officials who are now indicating they're actively working on guidance on these non-discrimination requirements. So we need it. There are a lot of open questions because the non-discrimination requirements, they're really three major elements. And they're not very, they're very subjective. The first is eligibility. The plan must benefit a class of employees that does not discriminate in favor of highly compensated. Well, you know, in the pension area, we have pages and pages of regulations on that. In this area, we don't have nothing. And so based on informal comments IRS has made over the years, most practitioners believe that if you satisfy the non-discriminatory classification component of the average benefit test of the 410B coverage regs, that'd be enough. And without going in all to the gory detail, it's basically comparing the percentage of Highleys benefiting to the percentage of non-Highleys benefiting, and it adjusts the passing threshold, making it lower the larger the population of non-Highleys is as a percentage of your entire workforce. And that's what we think, but we really don't know. Hopefully we'll find out soon. There's another pure facts and circumstance. Contribution and benefits must not favor highly compensated. Again, we've got pages and pages describing those rules under Code Section 401A4 for pension plans, nothing for dependent and nothing for now in Trump account plans. And lastly, the average contribution received by a non-Highly must be at least 55% of the average contribution received by Highleys. And I mean, that's straightforward on its face. And that may be very problematic for some employers, depending on their demographics. Before I mention my concerns in this area, other requirements: employees must receive a reasonable notification that they're eligible for this Trump account plan contribution and description of the plan's terms. By January 31 of every year, the employer's got to provide a statement to the employee showing how much the employer paid on their behalf and the expenses for that prior year. You've got to report it on the employee's W-2. And there's the potential that this may be an ERISA plan, which means it's now subject to the summary plan description, all the fiduciary disclosure reporting, and other fiduciary responsibility requirements. We have been told in the preamble to proposed regs, the DOL and IRS going to work on guidance to structure these arrangements to avoid ERISA coverage. We're waiting for that as we speak. The plan sponsor of the Trump employer contribution program must deposit the employer contributions directly into the Trump account of the beneficiary. This may be a challenge for payroll providers, particularly if employees are rolling monies from the initial provider to any number of other financial institutions. The employer has got to give a statement to the IRA custodian saying that this is a 128 contribution and it's pre-tax and not currently includable in the beneficiary's income or the employee's taxable income, thereby giving the trustee, the custodian, the necessary information as to how to report that amount when it's ultimately distributed. These contributions under employer program can be done through a salary reduction contribution if incorporated into a cafeteria plan. If you do that, however, the beneficiary receiving the contribution must be a dependent, not the employee himself or herself. And that's to avoid the cafeteria plan rules that say a cafeteria plan can't provide for deferred compensation other than through 401k elected deferrals. If you do it through a cafeteria plan, then you've got an additional layer of non-discrimination testing to satisfy the 125 rules. So it does get more complicated. And again, we need really some guidance in this area. So it sounds great, but the non-discrimination is going to be problematic, particularly for small businesses, doctor-lawyer plans. There's still need for guidance, so there are a lot of open questions. It's potentially subject to ERISA and therefore additional government reporting and everything else. So I think the 128 plan, employer-sponsored plan, sounds great, but there are certainly additional administrative responsibilities with regard to the plan document and the need to coordinate how these contributions find their way to the individual Trump accounts of the various beneficiaries. On permitted investments, I'll hit this very quickly. Congress wanted to ensure that these accounts are invested in American enterprise, and so it's got to be equities that track a qualified index of equities. The account must be a mutual fund or exchange traded fund, can't use leverage, must have an expense ratio of no more than 10 basis points, and the trustee must have procedures to make sure these requirements are satisfied. The index has either got to be the S&P 500 or an U.S. equity investment index that is not industry or sector specific. And as a result, probably target date funds are not going to work either because of the non-equity investments involved. As I said, the custodian's in charge of monitoring it. Let's finish up. What do we expect in the future? A broadening of, I think Congress may act to broaden the types of permitted investments, more flexibility for how donor classifications are determined. There's issues on gift tax, because if a grandparent makes the contribution, the normal contribution, it's not a gift of a present interest that qualifies for the $20,000 gift tax exclusion. I think that was oversight on Congress. I expect that to be fixed. And there's talk of extending the pilot contribution program to people born in after 2028. In closing, certainly opening a Trump account can give a child a financial head start in life. And I'm quoting from figures from a March 23rd this year personal finance article in the Wall Street Journal. I'm sure you can find it out there, as I said, for March 23, that ran the numbers at a 7% assumed rate of return. And if a person were to just get the pilot program contribution and it returns 7%, in their year of first year, so 18 years, they'd have $3,380 at age 18. And if they left it alone at 59 and a half, that will grow to $56,000. But for people with money, if you get the pilot program contribution and your parents make $5,000 contributions for each of the first, till the end of the growth period, it works out to be 18 years. And if you convert it to a Roth IRA at age 24 outside the kiddie tax, those $1,000 pilot and $90,000 of normal contributions would give you a $3 million Roth IRA at age 59 and a half. The key is making the kid leave the money there. And most importantly, being a tax lawyer, I have learned this adage very well through the year. Whenever Congress is in session, there's a chance the tax laws could be changed. And so nothing's guaranteed. People have been waiting for Roth to be repealed for many years. It doesn't look like that's happening, but I can't promise you what in all of this may happen in the future. So that takes us to any questions we may have. I know we're at the end of time, but perhaps we can squeeze a couple of questions in. Kim, do you have any?
So right now we don't have any questions. If you did have a question, feel free to type it into the chat.
That's good. Type it into the chat or send it to our Nova, what's our web seminars?
Yeah, so you can send any questions to webinars@Nova 401k. The handouts for today were attached to to go to webinar here. So in your upper right, if you see the little paper clip and paper icon, there are or handouts there. We did have one question come in, Craig, and that question is, are all the pilot contributions going to be created under Robinhood for the initial Trump IRA?
The answer is yes, at least for now. And I don't expect that to change. When I'm the only caution I have, it's certainly possible, but in the future, there may be some loosening of who can be the initial Trump account custodian. But as we now stand under what the guidance is, the only provider of the initial Trump account is Robinhood, and that's the only way you can get the pilot contribution. If it would require some change in the guidance going forward, which is certainly possible. The financial institutions of the states lobbied heavily, very heavily, to be able to be eligible to open the initial accounts. They didn't get their way. I think the Treasury thought it would be very difficult to roll this program out by the July 4th deadline with multiple initial trustees, but that may change in the future. But for now, yes, the only way to do it is through the Robinhood brokerage account and in setting up the initial account.
Great. Well, I think that was the only question. Feel free to email us at webinars@nova401k.com if you have any other questions, and we'll get that answered. Thanks so much for joining today. And
thanks, everybody. I appreciate it. Keep an eye for future webinars that we may do, and enjoy your summer. It's summertime. I'm going to Iceland and Norway for my summer vacation. So,
oh, very nice.
I'm heading out to the cool north. I'm looking forward to it in 2 weeks. So I'm almost on vacation after this webinar. Thank you again, everybody.
Thank you.